Hello, guys. Welcome to the show this morning. This particular show is not going to be all that pleasant, but I'm going to get on with it. You know, an awful lot of you guys, an awful lot of guys that listen to my show are guys that are guys and gals, men and women that listen to my show, are ahead of the curve. An awful lot of you, are preppers. And I made preps going all the way back to about the year 2000. Some of my preps are useless now because some of the canned food and stuff, I still have it here, but it's like so old I wouldn't want to eat it unless I really was in a shift. A lot of you guys that tune into my channel understand what a shift is. It's a disaster that brings the world down to its knees and makes humanity have to struggle to survive. And Venezuela has been sort of in a shift, but it can be even worse than that, even worse than Venezuela, and it'd be the whole world is in it, and it's basically something horrible you don't want to go through. Now, on my channel I've been saying that for a long time now that I don't think that this economic crisis is going to actually cause a shift disaster, a total worldwide anarchy type of disaster. I don't think it's going to cause that. But what I should say is what I'm going to do in this show is I'm going to lay out what I see as the different phases of the disaster. And if you start thinking about it, it's all going to make logical sense to you after you listen to what I got to say. So this is an important show. This show I'm going to do, it might be a little bit of a long one. I'm going to talk quite a long time about this to try to lay it out for you guys, what I see coming. What's happened is as this disaster that we're headed toward has slowly started to unfold in the financial system, it's giving me a better and better idea how it's going to lay itself out and how it's going to proceed, and I'm going to lay that out for you guys in this particular show. So this particular show should be fairly interesting. What these other channels are not telling you is they're talking about this economic disaster that's coming, and they're saying that it's going to be terrible. You're going to go into it, and the stock market's going to fall, and all the countries are going to go. But I see something a little bit different than they see. What I see is that we're going to go through a short period of trouble coming up. It's going to be deflationary, where what they're planning on doing with Deutsche Bank is they're planning on merging it with Commerzbank, and this is going to save things for a little while. But then Commerzbank and Deutsche Bank is going to go down together. Honestly, it's not going to solve things by merging Deutsche Bank with Commerzbank. You merge two failing banks into two failing institutions together, trying to save them, and that's a move of desperacy. They're desperate now at this point. They're trying to save Deutsche Bank because they know Deutsche Bank is one of these banks that they call them too big to fail. Okay, that means that they're so integrated in this system that if they fail, they'll pull an awful lot of other institutions down and everything down with it, and it's too big to fail. So those words should tell you what's going on. Their initial reaction is a move of desperacy to link Deutsche Bank together with Commerzbank. So they're going to create a bigger institution, and when it fails, it's even going to be a bigger problem. So now, what we got going on in the world, we got a number of world problems, plus a general slowdown in the economy, and we're headed towards something bad, and everybody can feel it. You guys can feel it. But now I'm going to lay it out for you, the stages of this crisis and how it's going to play out. And you're going to be surprised when you hear what I got to tell you. Going to be very surprised. This economic crisis is going to trigger an economic boom worldwide, but it's going to be very short-lived. Now, you're wondering, how can an economic crisis trigger a real economic recovery. And I've been talking about this for a while. And as I explain these things to you, you're going to start to see it. So we start to head into this recession, this next recession, and it's worse than 2008. It's of magnitudes larger than what happened in 2008. And if you guys remember what happened in 2008 after Lehman Brothers fell, how the financial system actually started to melt down. It actually started to melt down. And if it was allowed to continue, that contraction in the world's financial system would have led to a terrible crisis. They had to stop it. And think back, how did they stop it? The central bank of central banks and all of the central banks of the world worked in conjunction. The European Central Bank, with the two primary central banks that were working together, were the European Central Bank and the Federal Reserve of the United States. And you remember Ben Bernanke sitting in the chair, and they were asking him where trillions of dollars went. They said, Ben Bernanke, where did this money go? Trillions of dollars. And they said, tell us where it went. And he said, no, I'm not going to tell you where it went. He had so much power. Never forget how much power, and never forget what Ben Bernanke said. He said, and this is why he got the name Helicopter Ben. He said, if deflation comes and rears its ugly head, I'm not quoting him exactly what he said, but he said basically, we will fly over in helicopters and we'll dump money out to solve deflation. So let's keep that in mind, that the central banks of the world have endless money creation. They can create as much money as they want to create. But they have to have a reason. They're not just going to go out there and create money willy-nilly with no reason. There's no reason for it. In fact, quite the opposite. When they have the opportunity, they'll try to shrink their balance book. They'll try to remove money from the system, especially if they sense that another crisis is coming. That's their first gut reaction, is to remove money from the system, to try to make it so that they have a little bit of room to when the next crisis comes, to work with. That's why they're raising interest rates, the central bank, because they want to have that room to be able to lower them if another crisis comes. They're also withdrawing money from their balance book. They're doing quantitative tightening. They're pulling money from the system so that their balance book is shrunk down smaller, so that if the next crisis does come, they'll have some room to work with. They're like your doctor. You go into your doctor, and if it's only a tiny little infection, sometimes they'll withhold antibiotics from you so that they can save them, and so that they'll have something to work with next time you get sick. They're not just going to give you antibiotics willy-nilly if they think you've got a problem that's curable and that you're basically okay. But what are they going to do if you get something really, really nasty? Well, they're going to pump the antibiotics to you. Picture the central banks is the same way. They're going to pump the medication to you if you get sick. So they have to have a reason to do what they do. They have to have a crisis. And believe me, a crisis of magnitudes greater than what happened in 2008 is coming down the pike. It's coming, folks. So, what's the central bank's going to do? Well, it's a no-brainer. They're going to medicate. They medicate with money creation. This is how they medicate. But they have to have the reason. In other words, the crisis has to happen. It hasn't happened yet. We're not in the crisis rate yet. The stock market's up. We've had a Goldilocks rally in the stock market. Everything's proceeding as normal. Indicators, when they look at indicators look good. The jobs numbers look great. and they're pumping along, you know, keeping the quantitative easing going, and they might even be thinking in their heads right now about another interest rate hike, even though they said patient. They're watching the economy to see if the economy looks any way decent at all to give another interest rate hike. The Fed does not really see this crisis coming anytime soon. They're thinking to themselves, oh, maybe by the year 2022 we might have a recession. We're not going to worry about that now. Full steam ahead, boys. This is the way the Fed's thinking right now. Okay? But I can see these problems in the world developing that's going to lead us into the front side of a recession. And then once that recession develops, then dominoes are going to fall, and the whole thing's going to go faster and faster. And it's going to start into a crisis because Italy, Deutsche Bank, Great Britain, Canada, the real estate market, everything's going to start to fall at once. It's going to be like 2008. Everything's going to fold in on itself. And we're going to have this crisis. That's when the Fed all of a sudden is going to react. The Fed and all of the central banks are going to react when the crisis occurs. Okay, so now you followed me so far. We get this crisis, and everything starts to go into deflation. Homes aren't selling. House prices are falling. Falling prices, deflation. Automobiles are being brought back because you got millions of people who are late and delinquent on their car payments, and guys that work in repossessing cars. Their job offerings, car repossessor wanted, you know, just all kinds of new work for car repossessors across the United States. This is deflation. The stock market collapsing, deflationary. Commodities like gold, silver, and Bitcoin and everything else having a hard time, not going up very quick. This is deflation, you know. Money's being removed from the system, and people start hoarding dollars. People don't want to spend. They're scared. They're scared to spend. They decide to, well, we'll go without this week because the country's entering into a recession, and we better cut our costs. People start to cut costs. People start to cut corners. People start to eat. Instead of going into Olive Garden, they decide we're going to make a pizza at home, you know, sort of thing. And it's just a self-perpetuating, self-feeding cycle as we go into this recession. That's going to be the initial stage. It's not going to last very long because this recession is going to be so severe that the whole world, it's going to start to intensify really quickly once it really gets going. Okay? So we got that first stage. That's the first stage in the progression of this crisis. Then we're going to get the central bank reaction. Now, do you remember back in 2008 when we had the crisis happen? What happened? The central banks came into the rescue. They had to. And what was the result? Well, they called it an economic recovery. Well, it was sort of an economic recovery. A lot of money went into Wall Street, and we did have things pick up a little bit because some of that money filters down. There's a wealth effect where people's stocks go up and everything, and people feel richer. Home prices go up. Home prices went up, and people were able to take out loans on their homes and stuff, and money was starting to flow through the economy a bit better, and they called it an economic recovery. It was almost, it come close. If the Fed had done a little bit more stimulus, a little bit heavier, if instead of doing $80 billion a month, if they had done $100 or $120 billion a month, we would have actually went into an economic boom. But we didn't. They just did enough to make what was called a so-called economic recovery. And a lot of people bought into the economic recovery stuff. All the newspapers, oh, we're in an economic recovery. A lot of people bought into that, and it helped increase spending a little bit more. So we saw a bit of consumer inflation during those years, between 2008 and now, because of the partial, I'll call it partial economic recovery because of the stimulus measures by the Fed. Okay? This time, the recession is going to be much more severe, and so the reaction from the world's central banks is going to have to be that much more greater. They're going to have to throw that much more money at this thing. Well, pushing all that money at this thing, and never forget, they have unlimited money creation, and they're going to have to do this. It's either that or let the world fall into complete chaos and go into a complete depression where it would destroy everything. I mean, can you imagine if we went into a complete depression? What would happen with that? How would they make payments to the elderly and stuff? Everybody would go broke. The government would go broke. They're not going to let that happen. There's not a chance in hell that the government is going to allow themselves to go broke. It's just as simple as that. They will not allow themselves to go broke because they're not going to let the banks go broke. They're not going to let the whole system fold into an economic depression. They're going to react. And they're going to react swiftly. You've already seen the Fed reaction. When the stock market started to roll over there a couple months ago, and what did I almost said Chairman Bernanke, but what did the chairman of the Fed do? Powell. What did he do? He came right out and he said, okay, we're going to hold off on any more interest rate hikes. We're going to be patient. It was all the market needed to hear at that time because we weren't in the crisis yet. And that's what caused the Goldilocks rally is everybody said, hey, you know what? Good times are here again. The Fed's got our back. So, this time, we roll over into this recession. The Fed's not going to wait very long to react. So, this initial stage of the crisis that's unfolding when we start to enter into this recession, it's going to be first very severe, probably more severe than 2008. But the reaction from the world's central banks is going to have to be that much greater. They're going to have a much heavier reaction to it. More money creation. So then, all of a sudden, we start to move, just like in 2008, we start to move in the opposite direction. Their stimulus measures work, but this time their stimulus measures are going to work greater than they worked in 2008 because they're going to have to do more, bigger, better, brighter stimulus measures. So this time, instead of going into a half-baked recession, a half-baked economic recovery like we did last time, where some people say, oh, it's not really an economic recovery, and some people say, oh, yes, we're in an economic recovery. This time, everybody is going to realize that we are in an economic recovery because money is starting to float through the system. The velocity of money will start to pick up. People will start spending again. It's going to be a real economic recovery. But listen, that's the initial stage. That's just after the initial stage, and we're starting to go into the second stage of this economic problem. Now, I'm expecting that recovery stage is going to last quite a long time. So you preppers out there, don't think your preps are in vain. They're not, because we are headed toward the final stage of this crisis, which is going to be the stage that causes the biggest problems. So we go into this economic recovery because the central banks have printed all this new money. Okay? Basically, they don't really print it. They just enter it they just make the debts pile higher, much bigger. So the debt's going to expand hugely after we go through this next economic crisis, which is not going to last long. It's going to be deflationary. And then on the other side of it, we go into this recovery. So now picture you're in the recovery. What's going to happen next? Well, I'll tell you what's going to happen. As soon as the central banks react to this deflationary problem that's coming, this this crisis, as soon as they react to it, this is going to be the takeoff signal for 3 asset classes: gold, silver, and cryptos. This is going to be blast-off time to the moon, right? At the same time, we're going to see moderate inflation begin because of all of the new stimulus programs that are going to come in place. And this time, they're going to have to resort to helicopter money. And what I mean by that is they're going to have to start to consider ideas like universal basic income. It's going to be one of the ideas they're going to consider. And they're going to have to move into new programs that they haven't moved into before. Tax cuts to try to stimulate the economy. Infrastructure programs to try to stimulate the economy. And they're going to move into these. And this is what's going to stimulate the new economic recovery that we're going to be in. But at the same time, the velocity of money is going to start to increase, but slowly at first. I'm expecting this phase to be the longest phase. This economic recovery phase is going to be the longest lasting phase of the crisis. But the crisis is not over yet. Because as the economy starts to heat back up again, and the whole world's economy starts to heat back up again, we start to go into a worldwide recovery, this is going to be the trigger for the hyperinflation. This is your trigger, folks. And it's not going to start immediately, the worldwide hyperinflation. It's going to start slowly. It's going to be insidious. You're going to see prices start to rise. But this is also the blast-off point for cryptocurrencies, gold and silver. So, this economic recovery. And as we progress into the economic recovery, you're going to see prices increase faster and faster. I think it's going to take about 2 years for it to reach critical mass. In other words, it's not going to start as hyperinflation. It's going to start as inflation. And then as the weeks and months progress into this 2-year period, we're going to see people spending money faster and faster. And the economy is going to be booming worldwide. The central banks will be printing money like crazy. At a certain point, they're going to start trying to cut back a little bit. They're going to say, oh, these new social programs that we installed, like a universal income for all, we're going to start to remove these programs and stuff. And the people are going to resist. They're going to be mad. Okay? They're going to start to try to do these cutbacks again, the central banks. They're going to say, look, we're in an economic recovery now. We can do tapering again. They're going to go through the same cycle that we went through from 2008 till now. Observe this cycle. But during this cycle that we went through, we didn't get a hyperinflation, and the reason why is the Fed didn't quite push us over the edge. We're like a car. You push a car right up to the edge of the cliff, but it doesn't fall off because you didn't push it that extra foot further. That's the way with the hyperinflation. The Fed did not quite push us far enough to have the world fall off of the cliff and go into a hyperinflation. In fact, the threat was there. Didn't you see many channels on YouTube saying hyperinflation in 2013 because the Fed is printing money? It didn't happen. It didn't materialize. That's because they only pushed the car up to the edge of the cliff, but they didn't push it over. This time, the crisis is going to be so much worse that this time they're going to push the car and it's going to go over the cliff this time. So we're going to see this moderate inflation start to heat up at first, get hotter and hotter, and after a while it's going to be a runaway train. It's going to run away on the world's central banks. They're going to start to lose control over it. But it's going to be a slow progression. After we enter into this economic recovery, after this initial crisis is over, what we're going to see is the world slowly heat up, inflation slowly heat up, but it's leading someplace. After about a year or two of it, it's going to start to lead into the hyperinflation, the initial phases of the hyperinflation of all the world's fiat currencies. This is what's going to lead to the part where we need to have our preps. You preppers out there, you've prepped a little bit prematurely. What's going to happen but don't give up on your preps, because you're going to need them. Because when this hyperinflation really starts to begin, after we've been in this economic recovery for about a year, and the money is starting to go up higher and higher and less in its purchasing power, basically the whole world is going to look like Venezuela. The hyperinflation is going to get worse and worse. They're going to start to move more and more into these asset classes like gold that don't have any counterparty risk and who are deflating. Gold is deflationary. It's a deflationary currency. It's not inflationary. You can never make gold inflationary. It's impossible, I'm afraid. And it's the same thing with certain cryptocurrencies. Not all cryptocurrencies, but certain specific cryptocurrencies are the same way. They imitate gold. But gold, it's deflationary. So what's going to happen is as the dollar and all of these other fiat currencies are losing their value very rapidly, people are going to be buying things that are moving in the opposite direction, that are becoming worth more. It's going to be a mad rush into these asset classes. And in the final stages of this, because it's worldwide, there's not going to be enough of these asset classes to go around, and the price is going to go up. You can't put a price in terms of dollars on these asset classes like gold in the final stages of this. But what that's going to cause is, it's going to cause what once was the economic recovery that's going to last a while. That economic recovery suddenly is going to make a transition into something much more monumental, something much more dangerous, and something that the central banks cannot control. That's when we're going to have our shift. And I'm not sure exactly at this point how bad it's going to be, but it's going to be a hyperinflationary induced shift. We'll be lucky if it's only as bad as what's happening in Venezuela. And that's when the transfer of wealth is going to occur over into these different asset classes like cryptocurrency, gold, silver. They're going to be the recipients of this transfer of wealth. And all of the world's everything, the cars, the countries themselves, the land, the people that work on the land, all the world, anything of value is going to be transferred out of fiat at that time and into these asset classes that have no counterparty risk. And during that time, it's going to create such a tumultuous period, a period of everything being transferred. This transfer is not going to go, well, I'm not going to say it's not going to go smoothly, but it depends on how fast it happens. If it happens too quickly, the world is going to be put into a total disaster. So it's a ways away. It's in our future. So we have a number of stages in this crisis. The first initial stage is when we get this recession that's coming. The recession is going to slowly unfold into an economic crisis when things like Deutsche Bank goes down and Italy goes down. By that time, Deutsche Bank will probably be linked with Commerce Bank. Both of them will go down. Italy will go down. Great Britain will be in a recession already. Germany will be in a recession already. Canada will be in a recession already. Of course, Italy's already in a recession. The recession will be spread into these other countries. And China is probably be in a recession by then. And the whole world will be going down the tubes in this deflationary event. The central banks then react to it, and then we enter into stage 2. The money creation. We're going to call it, right now, we're going to call that the Great Print. Okay? The Great Print leads us into an economic recovery. That's stage 2, is the economic recovery. And it's going to last probably a couple years, while the fiat currencies inflate. Slowly at first, but then faster and faster and faster. They gain speed, inflating. At a certain point in that inflation of the fiat currencies, as it's moving faster and faster, it runs away from the central banks, and the central banks can't control it. Printing money will not help at that point. They can only control deflation. They cannot control hyperinflation. Once hyperinflation gets away on them, and people lose confidence in the purchasing power of the money, it's all over. The central banks can't do anything but stand back and beg for mercy at that point. So then we go into that stage 2, and it leads us into the hyperinflation. Then we go into the final stage of this thing, stage 3, and that's the bad stage for everyone on Earth. That's the stage where, if it happens fast, it's going to lead us into a shift. But if it happens slowly, if that transfer of wealth is rather slow, then we're going to enter into a new age for mankind. Everything's going to be changed. Everything is going to be changed. The way we send money across the internet, everything will be changed. It'll change everything. It'll change banking. It'll change an awful lot of jobs are going to be lost. Like certified public accountant. They keep a ledger. That's what they do. That's their job, an accountant. Why do you need them if the computer's keeping all the ledgers and keeping everything straight through blockchain technology? If all contracts are kept on blockchain technology, why do you need a certified public accountant, or why do you need a lawyer, say, to look up you go to the lawyer and you want to buy a piece of land, you know? You have to pay him big bucks to go and search the title or whatever, you know? And he has to go through all these files and stuff to find the title and blah, blah, blah. All these titles will be on the blockchain, on Ethereum, and enabled us with these smart contracts and stuff to keep land titles and stuff on computer. That's our future. So an awful lot of work for lawyers will be over. You know, we won't need as many. Not near as many lawyers. You know? And certified public accountants, I don't see us needing any of them. Once this full transition takes place over to computerized ledgers, because that's their job, is to keep ledgers. Can they do the job better than a computer? I doubt it. Anyway, so we're going to enter into this third phase, and what's going to happen is all the fiat currencies on Earth during this third phase, which is the hyperinflationary phase, are going to be destroyed. And there's going to be a transition of that wealth that those fiat currencies hold now. All that wealth, all the world's wealth, is going to be transferred into one tight little spot. And the spot's about this big. Tight little spot. And that tight little spot is cryptocurrencies, gold, and silver. So can you imagine all of the world's everything, all of the world's wealth being transferred into that tight little spot? These small little tiny markets. Do you know how tiny the cryptocurrency market is? And you know how tiny the silver market is? The only market that's got any size to it at all is the gold market. And it's not that big. So I say tiny little markets. These are tiny markets. Tiny little tight controlled markets. All of the world's wealth flooding into those 3 little markets. Think about that for a minute. Let it sink in. That's what's going to happen in the third phase of this crisis. But in that final phase of this crisis, it's going to transfer wealth over so quickly from what is now the paper rich. I'll call them the paper rich. You know, the Wall Street guys, they don't have hardly any gold or silver. They got all paper wealth. All this paper wealth is going to burn up and be extinguished. It's not going to be worth anything. The paper isn't going to be worth the paper it's written on. And all of the wealth is going to transfer over into these new asset classes. This is going to cause a disruption in the world. And the world is going to have to work through this disruption and come out the other side. That's your disaster. That's when you need your preps. That's when you need your canned food. That's when you need your rice you got put away for yourself and stuff. Because we, the working class people out here, the middle class and lower middle class people, we need to survive through this. And so, when you should be making your biggest preps is when we go into this economic recovery. And it's going to seem illogical, because when we first go into this economic recovery that's coming, the second stage of this crisis, it's going to feel like, hey, why do I need these old preps anymore? You know, I made these preps now. We've went through the economic crisis, which was the initial phase, by the way, the recession and stuff. We went through that. Now times are good again. Everybody's spending money again. I don't need this canned food. I don't need these bags of rice. I don't need that bottled water or whatever, right? That's how you're going to feel. So you might be throwing it all out. That's when you really should be prepping, because that's when the real inflation is going to be coming in, and that's when we're heading. That's the leading edge of the storm. So see, this thing's like a hurricane, right? And what happens in a hurricane? They get hit with the first eye wall, and the winds are going this way. You know? All the wind's blowing this way. And so then they say, oh, the hurricane's here. Look, we're getting hit. And then all of a sudden the winds start to abate. And they say, look, it's over, guys. It's over. We could go outside now. We could go for a walk down the road. We wanted to go down there to, look, the sun's out again, you know? Let's go for that walk a quarter mile down the street and see what damage was done with the storm. So they start walking down the dirt roads, you know, away from their home and everything. And then the other side of the hurricane hits, and they can't even get back to their house in time. And they get caught out in it. This has happened before. Don't let it happen to you guys. Because the first stage of this disaster, we're coming into this stage right now, which is this depressed stage where real estate prices are falling, everything is falling, and then the Fed's going to come in and pick it up. They're going to bring us into this recovery, which is going to be like the eye of the hurricane. And people aren't going to prep. Then the other side's going to hit us, which is the hyperinflation. And the hyperinflationary side is going to be the worst part of all. That's going to be the real crisis part. And that's when the money transfer is going to occur. All value transferred over from paper assets, it's going to be transferred over into digital assets. In other words, what's holding paper right now, like all your stocks and your bonds and everything is on paper, that's going to be transferred over into digital smart contracts. Right? And everything is going to be, the ownership of everything is going to be transferred over into these new digital tokens and into gold and silver. No place else. And so these three asset classes, gold, silver, and cryptocurrencies, and also digital smart contracts and everything else, is going to boom. But everything else is going to die. So this old way of doing things, the fiat monetary system and everything that goes with it is going to go down in a ball of flames, and the new is going to rise. The new is going to rise. Tremendous disruption. That's why you should prep for that. That's the part you need to prep for. Now, looking into the future from right now, I see this deflationary crisis, or stage one, starting probably within the next year. And then I see the central bank reaction happening fast, boom, like that. And once that central bank reaction happens, that's going to be the takeoff for gold and silver and cryptos. And then I see it over about a 2-year period, I see the inflation slowly heating up and moving into a hyperinflation. And then in the final conclusion of the hyperinflation is going to be a reset. Ultimately, at the end of this, it's a reset. And that's probably 2 more years. So this whole thing has probably got about 3 more years to run before it finally reaches the final conclusion of where you really need your preps. It might be your survival might actually be in your how good you are at prepping. But that's the way I see this whole thing concluding. Listen, thank you guys for listening. Like and subscribe, and we'll catch you guys in the next show. Bye-bye, guys.